God.
There he is.
And another you. You're looking good, my friend.
You always look good, Taylor. You always look good.
Man, what a dynamic week. I can't wait to unpack this. There's so much going on in the world right now. I have to say where I am in Alberta, Canada is basically shaking with the news because it so much affects the oil industry, what's happening in Europe right now.
Yeah.
And, you know, we're the oil industry for, you know, my American friend. We're the little Texas of Canada, like hardworking farm folk in the oil industry.
Right.
So it's been crazy. How's it been where you are?
America is kind of got their heads down and their butts up in the air and just paying higher gas prices and feeling like that's our support for Ukraine and for what's going on in Europe. Back when the American hostages were taken in Iran several years ago, it's a couple decades ago now, if not over, we had these yellow ribbons that we tied around trees, and it was this feeling of solidarity and this feeling of we're with you kind of thing. It was symbology, really symbolic. And that's exactly what these high gas prices are to Americans right now. Is there's a reason, and it matters. And so we're just doing our part. I think that's the pervasive feeling around the United States right now.
Man, and that's great because today we're going to be talking about those financial impacts and the micro and the macro, because I know that there are people out there that are looking at how to apply their options. Like they have a lot of money right now and they're thinking, you know, how do I, is there a game plan for turbulence? You know, is there a game plan for coming out of endemic or this crazy inflation? So I can't wait to introduce our guest. I'm super excited to welcome. Well, we're going to have the CEO of Raintree. So Raintree Capital, Raintree Group of companies. Scott, this is somebody that you know really well.
Yeah.
There's a lot of products and advice that Peter brings through Raintree Financial. Please welcome Peter Kinkaide.
There he is.
How you doing, Peter?
I'm doing well. Thanks for having me, guys.
So you are the CEO of Raintree Capital Financial Services. There are other companies or divisions that you run as well. Can you take us through a little bit about the Raintree perspective?
Yeah, absolutely. So our parent company is Raintree Capital. It owns 4 businesses: Raintree Financial Solutions, which is a private capital dealer. We have just over 40 financial advisors from Ontario all the way out to British Columbia who are registered with that company. And they focus on what we call our core plus explore investment philosophy. The core of a client's portfolio we think should be managed by a portfolio manager on a discretionary basis. And I'll get into that a little bit more. And then we're going to help our clients explore alternative or private investments to supplement or round out that portfolio for those clients. We also have Raintree Wealth Management, which is a portfolio manager and an investment fund manager. So it supplies, it is one of the options for that core part of the portfolio, managing more traditional stocks and bonds that most investors would be familiar with. We also have Raintree Insurance Services, which provides life insurance products to round out a client's risk management from both a planning perspective and also sometimes a tax perspective. And then finally, we have Raintree Corporate Finance, which provides investment banking and capital markets advice largely to business owners and business managers who are either looking at doing transactions from a mergers and acquisitions perspective, or they're looking for growth capital to meet their business planning needs.
Oh, that's fantastic. So it sounds like you've pretty much set up a one-stop shop. And can you describe the individual that is like basically doesn't know that Raintree is out there? Who is the person that's like, this is my place?
Yeah, that's a great question. I think we tend to service a slightly more affluent client base. And really, I would say individuals who maybe are looking for here in Canada, a non-bank solution. The banks dominate so much of the financial services delivery in Canada and the products and services, and we're really an alternative to that. So if you are looking for something different, if you are truly looking for more innovative solutions, I would say that Raintree is the right fit for you.
Now, Scott, you have known Peter for quite some time. I want to hear this origin story.
Peter and I found one another, I think, through mutual curiosity. I'm always curious to learn about the cultures and the macro cultures of where my clients work, and Canada is not America, thank goodness. It's better, in my opinion, and I'll say that on the record, like I just did. And Peter curiously was looking to find a way to take the Raintree vision to the Canadian market. And there's so many people that have their money in these large banking institutions, and the yield isn't there, and really the trust isn't there, and the vetting of these securities that are being sold a lot of times are just third, fourth, kind of word of mouth. And so Canadians are just used to investing their money or putting their savings into large banking institutions. And there's so many more opportunities for the greater good. And I'm sure we'll get into that with Peter, and even the way portfolios are structured. Even right now, with all the changes we're having in the marketplace, the 60-40 portfolio model, it's getting hammered right now, and people are losing money, and they're losing their value, they're losing their retirement, and that's not good. And so where do they go? And so they don't know there's another alternative out there. So Peter's looking for a way to get that message out there, build his team to focus on that vision. That's the work that I do. I'm looking to learn more about the capital markets in Canada. So I'm inquiring upstream. He's inquiring downstream. And he and a CEO of one of my clients had lunch together. And it was kind of love at first sight for me right after that, once I met Peter.
That's awesome. Well, when we take a look at what you were just saying, I need to unpack that for a second. You're talking about this lingo that is heard that not everybody grabs onto, which is this 60-40. It's almost like if somebody watches football, like a defensive formation, right? Like it's a formation of a portfolio. Am I missing that, Peter?
No, I think that's right. I think, to elaborate on that a little bit, the 60-40 portfolio has historically been a tried and true way for many investors to set up their portfolios. And what it is 60% equities or stocks or shares, different words for the same thing, and 40% fixed income or bonds. Again, same concept, different words. And those that combination of structure has historically been good from the perspective of, if stocks aren't performing well, then generally your bonds are performing better. And if your bonds aren't performing well, then generally your stocks are performing better. So it's meant to be a diversification tool for investors. And, really over the last 10 or 20 years, 10 years, 12 years, maybe, since the financial crisis, it's worked out really well for investors. We've had stock markets, particularly in the United States, to a lesser degree here in Canada, that have been performing quite well over that period of time. And you had bonds that have been on this steady decline in terms of interest rates paid, which is, I think, a pretty well documented story. And certainly through COVID have kind of gone almost through the floor. In Europe, you have actually negative interest rates, which is, I think, just a mind-boggling concept to me. But while that happened on the decline, as those interest rates went down, that's actually been really good for the value of the bonds. As interest rates go down, the value of a bond goes up. Okay. The problem is, once you get to the very bottom, and I know we've called the bottom, or many people have called the bottom for a while now, but once you get to the bottom and then you start to see interest rates going up, that then has the inverse effect. That actually reduces the value of your bonds. And so you have very stable bond portfolios that have lost 3, 5, upwards of 10%, depending on how they're invested and what they're invested in, this year alone. And so for, particularly older investors who have used those bonds to try and insulate or reduce the volatility in their portfolio, they're not used to making a negative return on their bonds. In fact, many people lost money in bonds last year as well in 2021. So this is a new paradigm where particularly the bond segment of the portfolio has been quite troubled. And on both sides of the border, the central bankers are signaling significant interest rate hikes for the remainder of 2022, which can only have the impact of continuing to deteriorate the value of bond portfolios. So really strong headwinds from a bond perspective. And at the same time, you've had this great run in equities over the last 12 years, one of the greatest bull runs we've ever seen. Some people would say all good things have to come to an end, and actually interest rates going up is a equities killer. And I can unpack that a little bit. But those are the two sort of headwinds that we face right now. And I think investors need to be a little bit more conscious of how their portfolios are positioned, and a little bit more thoughtful, and should be asking more questions of their advisors in terms of how am I positioned and how might I position myself in this face of uncertainty.
Well, this is more important now than ever, because when we are in these markets, like what we've seen of endemic markets in history is that like roaring 20s, where we're going to have more wealthy people in the next decade. We're going to be making them faster than we did in any decade previous. And if you were like me, who's a normal Canadian, like we have way less options for banking than they do in the United States, and our demeanor is to trust that, trust the consistency, right? But consistency also means failure to change. So those people are basically rising. There are people that are rising out of the cookie cutter. So let's say that the bank's group of services can kind of cover you until you start to multiply the average income significantly, right? And that's when those same strategies are going to hurt you more than help you. Is that what I'm hearing from you, Peter?
Yeah, I think to a certain extent. I mean, I think that within the banking sector in particular, there is a real aversion to change. And I would echo your comments that Canadians in particular trust our banks. Our banks were touted as global leaders, particularly through the last financial crisis, for their ability to weather that. But, our banking system is really an oligopoly, and oligopolies don't tend to spur on innovation. They don't tend to spur on risk-taking behavior. They don't tend to change all that much because they don't have to. There's no force of competition that's really making them, change or be innovative, those sorts of things. And so I think that's, left a real gap where, without being more innovative, without being more thoughtful about how money is managed, and without taking and adding a little bit of risk actually to the portfolio. And risk isn't a dirty word. It's an important part of investing. I think that many people shy away from this idea that they can talk about risk, and they become very adverse to talking about risk.
Well, Scott, you previously said that I remember us talking about how you said it's already too late. Like you have to make game plans that are in advance of when tomorrow comes. This has got a kind of same signal here. Do we have audio from Scott?
Yeah, you do. I think the thing that really our listeners need to pay attention to is that you're right. It's already too late, but the end of one cycle is the beginning of another. And that's where risk comes in. That's where seeing forward comes in. And that's what I like about Raintree's approach to the marketplace, is that they recognize the changes, and there's a full spectrum of products and services to adjust for and take opportunity of. And so you're not in this reactive mode of, interest rates are going up. Well, my bonds have already lost their value. No, we know interest rates are going up. And how do we make money in an increasing interest rate environment? So it's not a problem. It's an opportunity. but it's only an opportunity if there's a breadth of products and services that are offered to me and my wife and my family as I start to manage my wealth. And what we have to do as individuals is we have to go home and sit back down at the kitchen table, and we've got to take our statements out, and we've got to say there's got to be a better way. And one of the things we've learned through COVID is disruptive innovation. Now, to Peter's point about oligopolies, the banks don't want to compete because they don't have to compete. So how are they going to loan or make loans or reinvest in communities that need to invest in themselves? They're not going to do that. They don't need to do that. There's not a need for that. And there's a full opportunity spectrum there. And Peter's company brings those types of products and services to market as just one element of what Raintree Capital does. So to your point, it's already too late unless you're with people that understand where those opportunities are in the new beginnings. So there's problems, but where are the opportunities there? And that's what I like about Raintree Capital is they're always looking for, vetting as if it was their own money, those opportunities. So it's an opportunities mindset versus a banking mindset. There's a big difference there.
Peter, I see you nodding. Can you take us a level deeper?
Yeah. In terms of what Scott said about community and investing in community and trying to think forward, one of the areas that we really specialize in is identifying investments from a private capital perspective that are often investing in communities, investing in tangible businesses, tangible assets that you can see. I mean, I can drive around my own community here in Edmonton and I can see investments that we've raised capital for that are self-storage facilities. There are multifamily apartment buildings that we have raised capital for. So these are things that you can see and touch around the community. And I think that tangibility really resonates with a certain segment of our clients, and quite frankly also aligns with one of Scott's other points, which is positioning the portfolio for what's in your windshield. And one of the things that are in our windshield right now is inflation. And I think that's fairly well documented. Well, our belief firmly is that one of the ways to invest your portfolio to try and keep up with inflation is owning what I call real assets, buildings, assets, capital assets, farmland, commodities. Historically, these have been stores of wealth in inflationary periods. And so, that is the topic of the day. And I think that's something that I think comes to the forefront today in terms of positioning our clients' portfolios or making recommendations is trying to position for this inflationary period that we're in right now.
Yeah, I think that's definitely what a lot of us have on our minds, because you hear all these announcements and you don't even know what the impact is. Like, wasn't it just announced the other day that the only currency they're accepting for natural gas and oil in Russia is the ruble?
Yeah.
Like, that's something that's wild, and for me as the average business owner here in Edmonton, Alberta, I'm like, okay, well, I think that's going to probably not be awesome for their business and probably do like increase oil, but I'm not so sure. How do you see events like that?
Well, I mean, obviously the Russia-Ukraine conflict hits close to home, and Taylor, we're both in Edmonton, often referred to as Edmonchuk. So, first and foremost, because of our large Ukrainian immigrant population here, and so we, that we feel directly in terms of that community hurting significantly right now. From an economic standpoint, this conflict is bad for just about everyone. The Russians, obviously the Ukrainians, Europe, the United States. I mean, the impact of energy prices, and you talked about the Iranian conflict, and going back to the hostage situation and all that, the embargo. I mean, what did that do to oil prices in the 70s? They skyrocketed. What did that lead to? Huge inflation. What's happening right now? Oil prices are going up. What might one expect? Gas prices and every other output that oil has being impacted. And it, in today's world, it's not just oil. It's natural gas. It's all sorts of commodities. And in part, that was driven more by COVID and some of the supply chain issues. But we've seen lumber go through the roof. We've seen copper go through the roof. There's a shortage of chips still. There's a lot of headwinds. But going back to Russia and the energy situation, I still think we're early stages of how this is going to play out. Putin could continue to try and weaponize his access to resources. Europe is obviously beholden to quite a bit of that. Biden's in Europe right now, trying to get them sort of out of that jam and offering other support. But this isn't going to resolve itself anytime soon. That seems fairly clear.
And it's all over our news too. Scott, you've been sending me clips through this week, and we're seeing everything as far as like cosmonauts, right? Like I heard that there was rumors previously that people were nervous about the fact that there was a U.S. astronaut up there, right?
Yeah, and this is that unity we're looking for, this worldwide unity. And so the Russian cosmonauts landing up there saying, no, we're not going to hold you hostage. We're actually going to come support you. We don't agree. And then, of course, we heard the news that said, that wasn't why they wore those colors. That wasn't why. And I think what we're seeing is, and we've said this for the past couple of weeks, is this is a war that's been fought unlike any other. This is a true economic war. And to Peter's comment about risk and what we can see in our windshield as business owners, we need to start thinking about cybersecurity right now a little bit. And I know that that's an area that all of us, are small business owners, and protecting of assets, protecting client assets, protecting accounts. So we've got some opportunities here, and that's what recognizing opportunity is all about.
It's here at Leadership Atlantic Site, we're trying to raise the flag on that. We've got those. Remember when Morgan was on from Shift?
Yeah.
Shift Support. We've got him talking about cybersecurity, and I saw something online the other day that when established businesses get cyber attacked, like the starting to that is $200,000, like of dealing with that. So if it's a successful cyber attack. So I'm not sure what the actual numbers look like for everyone, but really when it comes down to it, if you feel as though this is an economic war, well, the way that you disable people from attacking you is to disable them. And a cyber attack will do that. They'll be worried about putting out fires in their own business rather than worried about their next strategy of business deals that might negatively impact you.
Yep. And it's it takes us back to the financial markets. It takes us back to why interest rates are going up. And when we talk about interest rates, we need to talk about the yield curve and the different maturities of when these bonds and these financial instruments, debt instruments mature. And so you got to be moving up and down the yield curve right now, depending upon where you see the adjustments and where you see the yield and where you see the price gains. So investing in bonds right now, to Peter's point, becomes more like an equity than it does a fixed income security. And so what does that mean? What did Scott just say? What does that mean? That's what most average people, when it comes to their money, are saying. What did he just say? They need to go get answers. They need to understand what their money is doing. Is their money secure? Is their money invested securely, that portion of it that should be? And are we investing in our community and giving back to the community by investing in real assets, to Peter's point, that increase in value during inflationary times? I'll bet, of the 1,000 listeners, whatever it is, that'll hear this in the next 2 weeks, over 999 point something of them are going, damn, I need to figure that one out. I need to revisit that. And that's the opportunity, is to just pay attention to it.
And Peter, I want people that should be talking to you to be able to identify themselves. So we use words like affluent, right? So like how do you know that you are making the cut to where this is going to be a good phone call for you to say like, hey, listen, I've grown my wealth inside of a bank and now I'm looking to see what's the alternative here?
Yeah, a couple of answers to that. One, we're not an organization that sort of rigidly says we only service this part of the population. We'd encourage anyone to reach out to one of our private wealth advisors and open up a dialogue. I would say that to start investing into, let's call it the private investment side of our company, our offering, you probably want to have close to $500,000 or more of investable assets. That really is when that starts to make sense. But there are other solutions, as Scott said. We have other products and services that service or serve or can serve just about anybody's needs. So I don't want to make an exclusionary statement there. But if you want to look at the private capital side, what we call alternative investments, then you probably need to have that $500,000 or more.
That's great information. And then, when you talk about like these outcomes of using this current strategy, and you're like, obviously there's no outcome that's guaranteed, but what do you think wins look like in this inflationary environment? Over the next couple of years, what do you think that the opportunities that nobody's talking about are?
Yeah, great question. I mean, first of all, keeping pace with inflation is not going to be easy. I mean, if inflation, it depends what metrics you're looking at and which countries you're looking at, but call it 5 to 8% right now. That's actually going to be tough to keep up with, given what we talked about in terms of interest rates and bonds, in combination with stocks that, have certainly delivered that over the last number of years. But I think inflation is actually a bit of an equities killer too. So, that's going to be challenging. So I think if you can keep pace in that sort of 5 to 10% range, adding some of the alternatives that pay distributions along the way, I think that that is something that you're going to want to think about in terms of adding to your portfolio. And there are no all or none sort of strategies. It's really about making the right modifications to a portfolio. So it's not to say, oh, we're going to pile into this one thing or this one idea. Nobody has a crystal ball, but I think adding some real assets is important. I think the other trend that is topical, and we've just launched an investment opportunity around, is carbon. The last 10 years, we've seen an absolute boon in focus around ESG investing, environmental, social, and governance, as being driving forces between investment making decisions. And the other trend is obviously the energy transition. So as you started off the topic or the session today, you talked about Alberta being sort of Texas of the North and an oil and gas economy, and absolutely it is. And we've really suffered over the last 5 or 6 years when energy prices were low. Now they've skyrocketed in the matter of 6 or 9 months. But this transition of greening up the energy that we use, whether that's using batteries and electric vehicles, whether it's using solar and wind and even nuclear, frankly, in terms of transitioning fuels, that's all happening. But governments around the world want, and to some extent need, to see that happen more quickly. And so what you've seen is carbon now being priced and taxed in a variety of different ways. And we think that owning carbon offsets is a really interesting way to play that trend. Carbon prices have continuously gone up over the last 10 years, and there's a number of targets that would suggest that they will continuously go up over the next 10 years. It's going to be painful because now we're paying, high prices at the pump, plus we're getting taxed. But the reality is, if you want to insulate your portfolio to this trend, I think carbon credits, owning carbon credits, carbon offsets is a really interesting way to position a part of your portfolio to what I think is a macro trend that is not going to reverse itself anytime soon.
Totally, because money is also expression, right? Like, are there people that are coming to you and talk to you about things like, Scott, you sent me over this Bloomberg announcement, World Bank sells first of a kind rhino bonds designed to protect wildlife. Like, are there people taking approach to investment like this?
So from my perspective, this is where wealth is going. This is where that economic stratosphere, net worth goes from A to B, and people are starting to realize that quality of life is more valuable than bank balances and portfolio balances. So how do I reinvest for tomorrow and leave a better quality of life for my children, for my grandchildren? How do I know that when I look at my statement every month, I'm going, man, I saved a family of rhinos, or at least I helped. And I'm getting a dividend to do that. I'm investing in the longevity of the animal planet, and I'm getting paid to do that. There's a return on my investment that is 2, 3, 4, 5% on my money. But how about the greater good? And I asked, what I'm hearing from wealthy individuals and CEOs, and even in boardrooms, the conversation is around, what did I do with my money that was actually a good thing? Not how much money did I make on my money. And so examples like that, and examples like carbon credits, right? Those are the things that say, you know what, I made money and I'm doing something better. I'm helping the environment. I'm helping the animal planet. Just look at, the Gates Foundation and these wealthy, high net worth individuals. What are they doing? They're investing in the greater good. Well, how does the common person like me do that? We've got to have more companies like Raintree Capital out there showing us those types of opportunities.
That's a great way to look at it. It's almost like the further you are up of Maslow's hierarchy of needs, once you're starting to express yourself with your wealth, that fulfillment end, this is exactly what that's drawing to. And it's actually seems to be what the new wealthy is.
Yep.
Peter, are you seeing any trends in wealth?
I am. I wanted to add on because, Scott, I totally agree with you. This is where it's going. This is the demand that investors have. But I also would encourage people to tread carefully. There's a concept that's gaining steam called greenwashing. And that is that, that those ESG factors, environmental, social governance, there's lots of rating agencies. There's now lots of different products that one can buy that are denoted to be strong ESG or ESG focused type investments. And I'm not sure that they always check all the boxes. Interesting story came out last week or this week around ESG. There was more Russian-owned oil companies in ESG funds than Canadian-owned oil and gas companies. How is that possible? That Russian oil companies would meet ESG factors. Now, I understand that in Canada, our energy does emit more carbon when being produced, so that's a factor. I get it. I don't see a lot of social or governance check marks coming out of Russia or a number of other major oil producers. And I think Canada needs to do a better job making it very clear just how committed we are to not only improving the carbon footprint of the oil that we produce through things like carbon credits, but also we meet a lot of check marks around the social and governance side of things.
Peter, I want to ask you about that. So you have a team of people in your office, analysts type people. These are sharp people. I've met them that actually vet these types of investments, that actually do due diligence on these types of investments. You have a whole side of your building there that is dedicated to assuring and giving us assurance as account holders. Speak to that department a little bit, if you don't mind, and those people and what they do.
Yeah, I mean, the investment side of our business is absolutely critical. And when you think about making investments, it's not just about coming up with ideas. It's coming up with the right ideas and working with the right companies and working with the right managers. And so we take due diligence very seriously. We have a corporate finance group of 5 going to 6 soon, who do nothing but look at these opportunities, vet the opportunities, meet with management, and do our very best to get it right when it comes to not only selecting the opportunities, but oftentimes we're providing advice about how those investments should be structured, what the terms of those offerings should be. So it's a very proactive approach. It's not reactionary. It's really about getting our hands dirty and trying to get it right.
Yeah, and that's important. I think that's an important piece, because a lot of times in these investment vehicles, you have a portfolio manager of, say, a mutual fund, a very large mutual fund, but that mutual fund group isn't necessarily vetting these individual companies that they're buying the equities in. They're not looking at that balance sheet any closer than a quarterly report, or looking at the threats that are associated with this business model that I'm asking our clients to invest in, are they?
You would hope they would be. I mean, obviously, I can't speak to every single mutual fund manager, and I don't want to sell anybody. But yeah, I would say that our approach is much more in depth when it comes to vetting these opportunities. Often because, especially on the private capital side, we're not we don't have the data necessarily available to go look at trading history and stock price and volatility and those sorts of things. It's a much more subjective and then objective approach to how we vet these opportunities. It has to be more hands-on to try and get it right. And so that is a real difference, because with these investment opportunities, it's also they tend not to have liquidity. So you can't trade in and out of them as easily as you might an ETF or a stock or a mutual fund. So if it's like marriage, you got to date for a little while before you get married. Otherwise, it's a very expensive process to unwind. and so, we think about it similarly, I guess, when it comes to getting married up to some of these private and alternative investment opportunities.
I appreciate you unpacking that. It looks like when we take a look at job markets right now, that there's a lot of people that are speed dating out there because America's going back to work, it looks like, Scott.
Yeah, these are big numbers. Here's what this tells you. That last sentence, according to the Department of Labor, the lowest level of jobless claims since 1970. That means we're at full employment. See, there'll always be a certain small percentage of any given society that doesn't want to work, that actually wants to just be handed welfare type checks and those kind of things. We can't stop that. There's no zero sum game there. That's what that looks like, what we just put up on the screen. 1.4 million lowest unemployment claims since 1970. And so that's the type of economy we're starting to deal with now, is one that is now all the labor force is back to work. And what does that look like? Well, from Peter's perspective and from a boardroom perspective and from a CEO perspective, I'm going to have to pay higher prices to my people if I want to keep them, because my people are in the highest demand that they've been in a very long time. And, I hate to say negative things about any type of industry, but I consider recruiters a lot like divorce attorneys sometimes, except they cause the divorces because they're in there looking for people to recruit from one place to another. And I have a great deal of respect for that profession. I do some of it myself, but I try to do it with grace and with reverence. And so what we're finding right now is we need to start to take care of our people. We need to make sure that our people are happy and that they're motivated. And how do we do that? We do that by making sure they're getting all the training that they want and all the education that they want. So there's opportunities in the economy for those types of investments. But what about our own companies? And what about our own communities? Everybody's back to work. And I'm speaking about the United States here.
And when you take a look at who they're paying for, it looks like they're paying for the ladies. We see that there is some raises from the U.S. labor, and women's wage gains outpace men's wage gains by the largest difference since 1997.
Yeah, and you got to love this. right? You just got to love this right here. Equality means hiring the best person for the job, the very best person, regardless of race, color, creed, background, the best person for the job. And a lot of times those are women. And now they're getting paid, and they're getting paid to stay, and they're getting incentivized, and they deserve it. And I know a lot of leaders out there, and some of the very best are women, very best, more level-headed, more pragmatic, more common sense approach, and they can see through a lot of the emotions. And so I'm very proud. I was very proud of the world, if you will, because hopefully that's a leading indicator and not a lagging one, right, Peter?
Absolutely. And it's time. Like this is a long time coming. There's been progress, but we need to get women on equal footing. Here in Canada, obviously, there's been a large movement around maternity leave, $10 a day daycare. Those are going to have great impacts on bringing women back into the workforce and making sure that they have the ability to stay employed, but also be important caregivers to their family. And that is really, really important progress that we're seeing up here.
And what I like about that, Taylor, you don't know Peter like I do, is that's just not talk. And let me be clear here. Peter is I believe the chairman of the board or some title around women in wealth. And Peter, why don't you take a moment and talk to us about women in wealth and the role that you've played and the role that Raintree plays?
Yeah. So we started this 7 years ago. It's a gala event in celebration of International Women's Day, which is March 8th. We started the first year, we actually called it Women in Investing, and it was a little bit more tied in directly to our business. We profiled some great female money managers, and we had a gala evening. We brought in 180 people. But coming out of that first event, which was just so well received, what we realized is if we kept it just about investing, it would become stale. And at the same time, it was a day in our calendars that wasn't particularly well recognized. There weren't a lot of other organizations doing anything around this. So we rebranded it last year, in that first year, to Women in Wealth. And we've continued on. So we've grown it from 180 people the first year to the last live event. We actually had just over 2,000 people between Edmonton and Calgary. And then last year we did a virtual. We had over 500 people at the virtual. It was great. This year has been our year of pivoting. And so we were unable to pull it off around March 8th because of some of the COVID spikes. But we've rescheduled, and we've got a live event coming May 14th in Edmonton. There will also be a virtual way to watch the event with Catherine O'Hara as our keynote, which is by far the biggest keynote we've ever had. And excited to be able to do it. So, the net proceeds go to the Canadian Women's Foundation, who do unbelievable work here in Canada around issues like women in leadership, also around domestic violence, which unfortunately through COVID has spiked, and it has not been good for that side of the gender equality equation. But we're delighted to be able to have raised a significant amount of money for that organization. And frankly, just bring light to this issue of inequality that is persistent. We're not there yet. We've made progress, absolutely. But our view is that if we continue to inspire people, that progress, that gap will close. And, my goal is to not really have an International Women's Day Gala anymore because it's become irrelevant. And so in the meantime, the medium-term goal is to continue to grow it in other markets and bring more awareness and support Canadian Women's Foundation. One other thing I'll mention, we launched last year, and we've continued it because of her campaign. This year we partnered with two female-led businesses, The Skinny and Paris Jewelers, to create a combination gift pack of scarf and necklace, and all of the net proceeds of that campaign go to the Canadian Women's Foundation. And the idea is to get the gift for someone and also go on to social media and recognize that person with hashtag because of her. And that's been a really rewarding campaign as well.
That's fantastic. And I have to say, both Scott and I are fathers of daughters. And honestly, I'm hoping that that there isn't any help by the time that they're older, because that's how much it's changed. And more so when I take a look at it, like I was joking before this, we were saying how our kids got COVID. And my youngest daughter, her name is Margot, and I'm pretty sure COVID wants a Margot vaccination. She's just a force at 5 years old. And I love the things that she talks about. Like, like many 5-year-olds, sometimes she ends up having to go to her room. Like there's natural consequences and there's consequences that we need to use to teach her. And I remember her telling me that it was her body and she got to decide where her body was. And I was like, this is a really interesting concept. And I couldn't help myself. I was just like, tell me more about this, because that type of confidence and that type of that's exactly what I want from my daughter. And that's exactly what we're talking about. Is I think that women in business is a wonderful thing. In fact, I'm outnumbered on my real estate company. Man, do they ever know how to help people? And man, is that ever valuable?
Yeah. Well, and last point on that then is we'd love to see more men at the event. I'd actually love to have a gender balanced crowd, because I think it's important for men to take a strong role in lifting women up, right? This isn't about bringing men down to women's level if in that inequality equation. It's about bringing them up so that everybody's equal up here. And so get rid of that hierarchy.
It's such a mixed perspective, hey, where some people are like, oh, that event is not for me, or I am not invited to a woman's event because I'm a man, because I can see how that's even an honest mistake. Like some people that have never been to a women's event think that it's about talking about how men are working against them, where these events are more about how we can all collaborate better.
Absolutely. And that's exactly the point I was trying to make is if we can come together and talk about it, then we can find solutions. And I think that, I will say every time I've gone to the event, I've learned something and I've been inspired by a woman, something that I can take away and think about either, how can I do something different, leadership roles, management style, frankly, just hard work. I mean, there's just been so many unbelievable stories of perseverance and inspiration that we've been able to share. And I'm just blown away by what I've heard. And I want to share that with men. I want them to hear it because it's important that they hear it just as much as it is for women as well.
How about the first Black female Supreme Court justice nominee sitting in the halls of Congress, and the men on that panel treating that person like it's embarrassing. I don't know of an American that isn't embarrassed with the way that we have performed in that hearing, and yet there she is, unbreakable, unwavering. Right? That's leadership. That's inspiration to me, right there. And we see it all around us. We need to recognize it, right? We need to recognize it. And I'm looking for the day that one of those clowns that's on that pedestal up there above her is in front of her for sentencing, because I want to be there for that one.
So if we look forward into the future, Scott, where's your scope set right now? Are you looking at the next 90 days? Are you looking like a year down the road? Like where do you think it's good to set your line of sight right now?
Yeah, that is the question. Let me be clear about this. What you're speaking to is vision. And each leader of each individual organization has different vision right now. When I say vision, I'm not talking about that grandiose vision of what our company will be one day and those kind of things. I'm talking about how far can you see what your company needs to look like in 3 months, 6 months, 12 months. How far can you see? And when you can answer that question, how do we get the organization there? And that's a lot of the work that I've been doing here over the past 3 or 4 weeks is reasserting vision, reasserting line of sight, and customizing line of sight to how far we can see vision. And so that's a lot of what I'm seeing in front of me right now is a customizable approach rather than a cookie cutter approach. So interest rates going up affects each organization differently, each ecosystem differently. So the question is, how does it affect your ecosystem as a leader? And how far can you see that effect into the future? And how do we build for that? That's a lot of the work that I'm doing. The other thing that I'll speak to on that regard is the reason we have Peter on here today. A lot of what we're going to do is going to depend upon our ability to do that. And a lot of our ability to do that is in our balance sheet and our assets minus our liabilities and our owner's equity. And how much is lendable? How much is borrowable against my balance sheet today versus 6 months from now, given that environment? So if I'm going to go get a line of credit that I'm going to need in 6 months, I better go get it now, because balance sheets get deteriorated in these types of markets. If I'm a publicly traded company, what does my stock look like if there's a correction, which to Peter's credit, he let us all know that as inflation goes up, equity markets take a hit and go down. We've got to start to envision our balance sheet in this new environment and plan accordingly as a component of our forward looking.
Peter, same thing. Are you looking further than that? Are you looking rather close range to be agile? What, where do you set your vision as we go through this, these turbulent times?
Yeah, I think you sort of have to have the short-term tactical strategy as things change around you. But from a business perspective, I want to be thinking, much further down the road. What does our organization look like in 2, 3, 5 years? And put the pieces together today to try and get us there. So it's tough, particularly COVID, I think, has been tough for looking out further because of the uncertainty and sort of the waves that have gone on. Reminded me actually quite a bit of the financial crisis where, a fog sort of sets in that doesn't allow you to think longer term, doesn't allow you to see longer term because of how much uncertainty is unfolding in real time. But I feel like that fog is starting to lift. And, one thing I'll say, and this is really unique, is I painted maybe a negative picture from an investment perspective about how I see some of these things impacting the portfolio. But economically, and Scott, your point about jobs and, GDP numbers look good. Part of this inflation is being driven by all of the money that got pumped into the market. Well, it's supercharged now. And now it's hard to find people. Now it's hard to retain people because of what's happened. But that's actually good for the economy. Like from a business perspective, I'm actually pretty optimistic these days from purely hey, there's lots of things going on. There's lots of activity. Even, spring seems to have sprung, the emails, more phone calls, people looking to do things, people traveling for business again, which is heartwarming. That has made me really optimistic from a business perspective of where our economy is heading.
Yeah,
I can see that. The thing that I see changing so much is the price of competition. So as a marketer, basically the noise level is rising. Getting above that noise level is the key. I'm talking to so many businesses right now that through the pandemic, it's almost like they took the sails down from their sailboat. They ended up moving into this circumstance where they were just kind of coasting along. And I hear these things that people say like a badge of honor. 85% of my business is coming repeat and referral. It's through my network. And my question is why doesn't anybody else know how awesome you are? Being visible right now is being valuable. And there's so many businesses that are not, their settings in their marketing are from a time where people had less money to spend. Therefore, the cost per acquisition was much lower. The cost to get exposure was much lower. And now they have to be more dynamic, but we also raised the level of play. The entertainment value of advertising changed so dynamically during COVID that some of the people coming out right now into this environment where there's a lot of opportunity, they're just going to clean up. Like, the growth is going to be amazing. And there's going to be some other people that just feel like they're sitting out.
Yep. And you know what? The one thing that's really changed that I think we're all going to start to think about, and I talked about the value mindset to the price mindset as prices go up. We talked about that, Taylor, over the past couple of weeks. But the word competition, that definition has absolutely changed. It's no longer your competition because I make this box and you make the same box. It's close and we're competing for that order. Those days are done. Competition now is the opportunity to compete for the time and attention of someone who you'd like to introduce to your products or services. Like, how many chances did I have to tell my story this week? How many people did I give all the information they need to make a decision? Because you just go down the cereal aisle at any grocery store. How many cereals are on that aisle? And now they're not only competing to be on the aisle, and we've heard about shelf space and eye level, or lower is less money and higher is more money. And so you've got to train this way, but forget all that. How many cereals are there? Per capita of shopper, there's way too many cereals. And so what's going to happen is there's too many choices. And so what happens to businesses, and in Peter's business, where the consumer, their private wealth is the customer, is the client, there's so much noise out there. There's so much going on. And so the real essence of competition is, how many opportunities did we get to tell our story?
And this is actually why Raintree is so valuable. Yeah. Sorry, Scott, I cut you off there.
That's all right.
Raintree is so valuable because in the age of information, it's insight that creates the difference. Like, without the insight, we have the entire history of the universe in our pocket, like all of us. So why aren't we all winning? It's because how much time can you actually engage that cereal aisle? Did you spend time reading all the labels? Do you know all the options? Now, when the next shopper shows up to the cereal aisle, are you equipped to say, hey, listen, I can change your outcome? Because that's what the consumer wants. Like, that's what I see from marketing about showing the inside on the outside. Is the truth of the matter is what's in it for them, and why should you be my guide? I love the name Raintree. Because honestly, like, it is a jungle out there and you need somebody that's going to walk you through it.
Yeah, it's well said, Taylor. It's well said. Peter, as we wrap up today, a couple of questions that I think are on everyone's mind. We kind of danced around a little bit. What does the CEO of Raintree Capital see in the markets and say the next 3 to 4 months? Where do you see the equity markets going? Know it's your opinion. Know it might not be shared. But what do you see in the equity markets? And where do you see some opportunities?
Yeah, I think that unfortunately, I'm pretty negative about the next 3 to 4 months. Call it the sort of year of 2022. I think that interest rates going up and inflation being persistent is bad for equities. And so I think that's going to be a real headwind. There will be pockets that perform better. Commodities, this to start the year has been good. In fact, the Canadian equity markets has outperformed significantly the U.S. equity markets, and that's largely driven by commodities. So, there will be pockets. I think one needs to be thoughtful. One of the things that people forget to do is, the old adage is buy low and sell high. Well, when things are so good, people forget to sell high. And so taking a little bit of your gains from this last period of time, and frankly, maybe just putting it into cash until you find a better price again, buy low again, that I think is a reasonably good strategy. There are ways to be short the equity markets, and that's some of what we bring to bear from a Raintree Wealth Management perspective. So in our portfolio manager, there is a component of our portfolios that is short the market to try and capture positive gains, even when negative returns are in the market. And I do think if you're ready to look at something truly different, the private capital and alternative investment side of our business, come talk to us about real assets, land, farmland, buildings, real estate. I think are very topical. We do have other investments that are commodities focused. We have this carbon credits fund that I mentioned. I think we have some really interesting investments that are on trend for what the market is delivering in our windshield.
You know what it sounds like to me, Taylor? It sounds like Raintree is just like this access to opportunities place. Just you just have access to opportunities. Does it sound that way to you?
Yeah, like when it comes down to it, there's so many opportunities out there that I need that help selection, right? And honestly, for those people that are the new wealthy, the people that are coming, like up and coming, that are seeing these options for the first time, I think that this should be a clear calling.
Yeah, I agree. Peter, thank you so much for your time today. It's always good to see you, sir.
Gentlemen, I really appreciate you having me on.
And we're so happy to have you on. This has been Leadership Line of Sight. My name is Taylor. I am the marketing strategist at Gravidia. I'm here as always with the Chief Change Officer of Crankset Group, Scott Connors. And our special guest today was CEO of Raintree Capital, Raintree Financial Solutions, and those options that we just mentioned. Thank you so much for joining us, Peter. And I hope that you have a remarkable day.
Thanks. You too.